Walt Disney Company remains one of the world's most iconic entertainment conglomerates, spanning media, sports, and global theme park experiences. Despite macroeconomic headwinds and shifting media consumption, Disney continues to post solid financials, driven by its diversified business model. According to the company's latest SEC filing for Q3 financial year 2025, the company reported total revenue of $23 billion for the quarter, up slightly from previous year, and was $71 billion for the first 9 months of the fiscal year. That's an increase of 4.6% a year. Disney divides its empire into 3 core segments: entertainment, sports, and experiences, each contributing a distinct slice of the company's overall results. Entertainment encompasses film studios, streaming platforms like Disney+, Hulu, and Hotstar, television networks. That remains the largest business. The company finalized full ownership of Hulu in June 2025, paying an additional $0.4 billion to NBC Universal, a transaction that also brought a non-cash tax benefit of about $3.3 billion. The sports segment, dominated by ESPN, benefited from the integration of India's Star Sports operation and improved international performance, posting about 29% year-over-year increase in the operating income. Meanwhile, the experiences segment, home to Disney parks, resorts, and cruise lines, delivered another strong quarter with 8% revenue growth and 13% operating income growth, driven by higher theme park attendance and the launch of a new Disney Treasure cruise ship. For the first 9 months of fiscal year 25, Disney's segment operation income rose to $14 billion from $11 billion in 2024. After corporate and interest expenses, the company reported income before taxes at nearly $10 billion, up notably of 50% from $6 billion the prior year. Operating margin expansion was driven largely by cost discipline in entertainment and pricing power in experiences, though the company continues to absorb streaming amortization and acquisition charges tied to its 2019 Hulu deals. EPS is a key measure of how efficiently Disney turns profit into shareholder value. For the quarter ending June 2025, Disney reported diluted EPS of $2.92. On a year-to-year basis, diluted EPS reached $6, up from $2.4 for the same period in 2024. The jump reflects not only operating strength, but also a smaller share count following continued repurchases and ongoing cost rationalization. For the first 9 months of fiscal year 25, Disney generated $13.6 billion in operating cash flow, up from $8.45 billion a year earlier. Capital expenditures, largely for parks and cruise ships, totaled $6 billion, while net cash used in financing activities was $8.1 billion amid debt repayment, dividends, and share buybacks. Beyond the numbers, Disney has reshaped its media portfolio. The Hulu buyout consolidates direct-to-consumer streaming under one roof. A planned Fubo partnership will combine Hulu Live TV assets with Fubo's distribution, giving Disney a 70% stake in the new entity. And the new India joint venture with Reliance reduces exposure to India's volatile media market while retaining a 37% equity interest. These moves aim to streamline operations, focus capital allocation, and drive long-term margin expansion in streaming and experiences. Disney's 2025 story is one of transformation and rebalancing, from restructuring its media footprint to investing in high-margin experiences. While headwinds remain in linear TV and international streaming, the company's core parks and content engine continues to generate meaningful cash flow and double-digit profit growth.